Welcome back, YouTube. It is your boy Colton, and we are trying something new today. We are actually going to go back to the old whiteboard and just go over two stocks I'm taking a look at. Since Kroger missed earnings, it has just absolutely been just getting destroyed. I wanted to compare Kroger, which is an absolute food giant, to Sprouts, which is the poor man's version of Kroger. I want to do a stock comparison of these two companies to see where I think there's more value and more opportunity. So let's get into it. Let's just start out with their market caps. Right now, Kroger has a market cap of about $30 billion. And Sprouts currently has a market cap of about $2.6 billion. Kroger's market cap is roughly 11 times the size of Sprouts' market cap right now. The first thing I want to take a look at is going to be their PE ratio. Now, this is just a surface check. This is just what I'm looking at. You can find this on any platform, whether it's Yahoo Finance, you can find it on Seeking Alpha, but we're going to go with just the PE ratio. And right now, Kroger is trading at about a 9.8 PE ratio. Sprouts is trading at a 9.8 PE ratio, while Kroger is trading at almost a 31 PE ratio. So right off the bat, I think there could be some value had just by looking at the PE alone. Now we're going to look at forward PE. And basically what a forward PE ratio is what's the projection of what the company is going to do in sales, and then you get a price to earnings sales on that projection. Kroger is actually only 12, which is pretty, 12.6. So the forward PE on Kroger is 12.6, which is fairly reasonable. Sprouts is at 11.5 forward PE. So right off the bat, when we're just looking at the surface level stuff, I'm finding a pretty decent amount of value right off the bat eyeing Sprouts over Kroger just by surface level checking. The next thing I want to look at is going to be their revenue. What is their revenue and what is their revenue growth? So Kroger is obviously a giant compared to Sprouts. Their revenue is probably going to be astronomical compared to Sprouts, but let's try to keep percentages in check here. So right off the bat, we can see that Kroger has a revenue of a trailing 12-month revenue of 133 billion. So that is huge. Okay. And their revenue growth was 3.5%. We look at Sprouts, their revenue was 6.28 billion, so we'll call it 6.3 billion trailing 12 months. And they had revenue growth of 2.99%, so we'll just round it up to 3%. So right off the bat, revenue and revenue growth is absolutely going to be Kroger from this point, right? Clear as day. Here's the interesting thing. The net margin for Kroger is about 1%. The EBIT margin is about 2%. So net margin is 0.87%, while EBIT margin is, what did I say it was? While EBIT margin was 2%. Net margin for Sprouts is 4.34%. And their EBIT margin is 5.9. So they're dominating, even though they're not dominating on the growth and income, they are absolutely killing it compared to Kroger on their margins. And let's be honest, the bottom line is more important than the top line, in my opinion. If you can extract the most from the bottom line, well, that goes right back into the business. So right off the bat, I can get past this, but this right here is just too big to ignore. So good margins, considering that it's in the food industry and usually you have very, very slim margins in that. Sprouts does not pay a dividend, but right now Kroger, because of their dip that they've had from their missed earnings, they're yielding just about 2% for a dividend, so pretty good dividend there. And you know, they're actually retracing back to the $30 range, where, you know, back into the 30s. They're sitting right now at $41 a share, while Sprouts is sitting right around. Give you guys a heads up, Sprouts closed at $22.59 and Kroger closed down at $41.10. 52-week high for Sprouts was $29.35 and the 52-week low was $18.21, while Kroger had a 52-week high of $47.99 and a 52-week low of $30.35. We're going to go over the charting after, but you know, we'll talk about that later. Okay, so obviously Kroger wins the dividend battle. Return on assets. You know, this is something that is actually gets overlooked a lot of times, but I find it as a, you know, an interesting check mark to have in the box. You want a company getting good return on assets. That means that they're putting their money in good places that is building their business. So for Kroger, the return on assets was 3.5%. The return on equity was 12.2%. And for Sprouts, the return on assets was 7.9% and return on equity was 32.2%. So they doubled them in return on assets, and they almost tripled them in return on equity. So return on assets and equity go to Sprouts once again. So now what we're going to do is we're going to dig into their opportunities. This is where it gets super interesting, and I think this is where it becomes super clear that Sprouts is a undervalued stock with a lot of upside, not a lot of downside to it. They clearly dominated on the surface check. So right now I'm going to look at them and the opportunity that I think needs to be uncovered, because it's pretty mind-blowing when you think about it. By the way, if you want to join our free stock group, it is on Sunday nights around 6 p.m. If that time does not work, leave a comment down below. Let me know what time works best and I will try to accommodate. But let's get into the opportunity for Sprouts. From everything that I read, it looked like COVID threw a big wrench in their revenue growth opportunity, plus their growth as a business. So we're going to dive into what that opportunity is and how it's going to impact their 2022 outlook. So currently Sprouts is only operating in about 362 stores. Through 2020, they were trying to open up about 10 to 15 locations. That obviously got sidetracked due to COVID. So what they're doing now is they're opening up more strategic locations. It's going to be about 20 stores that are going to be opening this year into next year. And that is going to entail more city-like areas, such as 20 different locations for stores this year. 10 are in the cities of Tampa, Miami, Orlando, and they're obviously having an emphasis on Florida. In addition to the 10 locations coming to Florida, the grocer will open 2 locations each in Georgia, California, Arizona, and Texas, Denver, Colorado, and Reno, Nevada. As you can see, they're focused on getting into more upper class cities, if you will, cities that are pretty expensive and where I think that health of organic food is more emphasized in. So they're very focused on providing services to a specific client, and I like that. It allows them, they're still small enough to shift in different directions, and if they make a mistake, they can recover, and their margins are pretty solid overall compared to the market. So as you can see, Sprouts is going to be growing over the next few years. I mean, you know, that is a 5% increase in store locations in less than a 12-month period. So that's pretty substantial amount of growth, considering that they were coming out of a pandemic where it was pretty concerning for more of the smaller businesses. A lot of the larger businesses like your Walmarts and your Targets, they can scale now, so they're not as exposed, but these smaller companies that, you know, are focused in primary locations are definitely more vulnerable. So the technicals on Sprouts is a little gray right now. Came out with some news stating that they had some logistical problems and that earnings were going to be downgraded by single digits. You topple that with Kroger also coming out and saying that they had to taper their expectations to year end. And the stock has went from $29 looking to break $30 to crashing down to $22.50. Seems to be some support right around $20. So I think, if you can get in Sprouts around that $20 mark, I think there's some opportunity for major upside going into next year. Obviously with logistics, I'm a little concerned, but I will say the one shining nugget about Sprouts that I do like is that they're pushing for more locations. They're in this growth phase still. And on top of that, the nice thing is that they have pretty good margins compared to the market. So I like that. I like the fact that they're laser focused in their business. They're still kind of in the growth phase. They're still lean and mean, and their price is fairly cheap overall, in my opinion. They could absolutely be trading at a PE ratio of 15 to 20, and you could be paying almost twice what you're paying right now at $22.50. That is just my opinion, but when you compare it to the market, Kroger is trading at almost at 30 PE and was trading well above that before it missed earnings. So you could absolutely put a 12 to 15 PE ratio on a company like Sprouts that is still growing and still has good margins and still has a lot of upside to the company and overall. So I hope you enjoyed my dive into Sprouts today and Kroger. And as always, guys, I appreciate your time. It doesn't cost you anything to like and subscribe, so do the right thing. And we will see you next time, investors. Peace.